Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today I want to highlight a few mistakes that new investors tend to make. And this is one we haven't talked about in the past. We've done a few videos like this, but also one that I think is under-discussed, one that people don't talk about enough. And I'm going to walk through everything on the whiteboard as a good math teacher does. I used to be a math teacher, for those that don't know. I'm not a math genius. It was only 7th grade math, so relax, okay? If you ever see me make a mistake, it's okay. I'm not perfect either. But these are some mistakes that can help you to avoid. So the way that this works is by not really understanding the math concepts behind investing and really percentages. And I ask this question, or I say this rather, because I get asked this question all the time. And the question is, hey Kevin, when you are buying into a stock, at what percent do you sell and what percent do you sell like on upside to take your profit, and then what percent do you sell and say, look, this isn't for me, I'm gonna get out of it? Where do you set that stop loss? For those that don't know, a stop loss order basically says, hey look, you've lost enough money, we're gonna get out of here and really save the rest of your capital, save the rest of the money that you have for another trade, for another day. Here's the thing, y'all have probably never heard me say 5% is where I'm trying to get out. 5%, 10%, whatever percentage it is. I've never said that. I give two types of answers. One is don't really look at the percentage, look at the time. Has it been 6 months? Has it been a year? Has it been a quarter? The reason why I say those numbers is because that's a normal time for you to sit back and reevaluate your portfolio, take into account what we know now, which is not what we knew 6 months ago, and make those adjustments and decide when to buy or sell. The other thing I say is I also compare it to what the stock market is doing and judge it based on that. So for example, if the market is up 10% and I did better than that, then cool, I'm fine with that. It's hard to beat the stock market in and of itself, and if I happen to choose a few companies that do, you get to stay. If I choose some companies that don't, you got to go. And that's just the end of it. That's even when the market is down. So if the market is down 10% and I only lose 1%, I'll take that. I'll take that. It outperformed the stock market. Again, beating the stock market is hard. It doesn't really lose money often, even though this year, that is not all that great, right? But on a year-to-year basis, it doesn't happen all that often. So I'll take a 1% loss if the market is down 10, right? I'm just looking to beat the stock market because I could do exactly what the stock market does if I put everything in an index fund, which is not a bad thing to do. It's not a bad thing to do. However, I am trying to do just a tad bit better by choosing individual stocks, dividend stocks, stuff like that. Okay. All right. So let's take a look at what this actually looks like and why I don't do this particular technique. So some people say, well, look, let's say you're investing $100 to make things real easy and simple. Let's say we're investing $100 and your rule is 10%. You make 10%, you take your profits. You lose 10%, you take your loss and you move on. Well, here's the thing. Well, if you start off, let's just say we're not going to be perfect, right? You lose 10% on $100, it leaves you with 90. Okay, great. I jump back into the stock market with my $90 and say, all right, I need to make 10%. That's my goal. And this time, I make my 10%. That leaves me with 99. Here's the problem. 99 is not 100. I still lost money, even though the percentages are the same. I made 10 and I lost 10, but I'm still down really 1% overall because it's, $100, 99, 1%. So I'm still down. And if you continue to do this, the math doesn't work in your favor. When you take a percentage loss, it takes more than that percent to break even. And you can really fall into a hole by thinking that you just set your goal based on a percentage in and of itself and absolutely nothing else, which is why I don't do it. A better approach, there are actually two approaches to solve this issue. Well, three if you really want to get technical. But the first approach is when you ask me, when I sell, if I'm doing a trade, I'm trying to get in and out of something pretty quickly, I'm really looking for a price point. Perhaps I'm looking at a chart, perhaps I'm, I have some magic formula for me as a chart, but perhaps I'm looking at things and saying, I need this stock to hit $60 a share. When it hits $60 a share, I'm getting out of it. Or if it goes down to $55 a share, I'm getting out of it. That's just the end of the day, right? But it's really focused on the profit point. So in this case, instead of saying 10%, I'm going to say $10. And the thing is, the reason why this works is because even at $90, $10 is still $10. That's more than 10%, right? So for example here, let's say I start with 100 and let's say I lose $10. Y'all know how this goes, right? That leaves me with $90, okay? And then I get back into something and then it works for me and then I make that $10 and now I'm even. So in both scenarios, right, maybe you're choosing the exact same stock. That's the interesting thing too. This could be the exact same stock. Me and you could buy the exact same thing. We both lose money the first time. We both make money the second time. But now I am up 1% and you are down 1% based on the rules, based on how we were judging this particular stock. I got out at $10 profit. You got out at 10%. And because we started out at $90, those are two different price points. And that's how people can still invest in the same things and still get different answers because the structure isn't really there. And what you're looking for may be flawed in terms of the percentage amount. And that is one thing that can lead people down the wrong path. So keep investing, keep doing this, keep doing that. I did exactly what you said and I still lost money. Why? Well, could be your rules are set up in a way that's not beneficial to you, because now you have to shoot for 11%, 10% every time you lose. You got to go even bigger on the gain side, which forces people to be more aggressive, to take on stocks and risks they're probably not suited for, and then things get worse and worse and worse, which is not a place that you want to be. Having these regular profit numbers and saying, I'm looking for this trade or every trade, depending on how you want to do it. Every trade I'm looking to get $50. That's it. And if I lose $50, I'm out. That way I know when exactly I can break even. And the very next trade I can break even. Now that is one way to do it. I don't think that is the best way to do it. I think a better way to do it, or the best way to do it rather, however you want to phrase that, is by setting up the correct ratio, or not even the correct ratio, a ratio. And here's what I mean by that. A lot of traders either shoot for what they call a 3-to-1 ratio, meaning that out of 3 trades, I only need 1 to go correctly for me to make a profit. So every 3 trades, I only got to be right 1 time. That's 33.3%. It's Pi Day. You knew the math was coming. So let's say I just need to be right 33% of the time. That's it. That's bad. But I think I can do that, right? So here's how that would work. In this case, my goal here is to either make $10 or lose 3, which means let's say a day like today where the market is down, you lose $3, you get out of it. You move on to the next one. You cut it short and just, hey, we lost money, we move on to whatever that next trade is going to be. And here's why that's important. So in this case, right, let's say, again, we start with $100. You can add the zeros, doesn't matter how much you trade with. But you start with $100, you lose 3 on the first one. Okay, that gives us 97. Great. We start again, we try and be fancy. We hop in and say, all right, well, I'm going to trade again. And then we lose another $3. Darn, now I'm at 94. Okay, we tried again. We are persistent. And this time we hit our price target. We get out at $10. Well, now I'm at 104. So now I started out with 100, right? And at this point, I'm at 104. I've technically made 4%. I was wrong twice. I was wrong 66% of the time, and I still was able to make a profit only because I had that 3-to-1 ratio, close to 3-to-1 ratio, basically, where I say, look, if I lose $3, I'm out. If I make $10, I'll take my profit and I'm out. Now, could the stock, in that last case, make way more than $10? It absolutely could. You never really know. Or it could make money the next day and then fall. You don't know, right? But this structure is what can help you to make sense of the market, but also place yourself where you don't have to be right every single time. When you're saying I need to make $10 or make 10% and lose 10%, and that's just the rule, then you got to be right a lot, right? You got to be right a whole lot. So if you are right and wrong, you're just 50%, you're just going to stay even, right? And for you to be right every single time, especially in a time like this where the market is hectic and we got Fed announcements, we got earnings, we got war in Russia, or war in Ukraine rather, that's really hard to do. And this is one of the reasons why people who trade don't make money often, why people aren't very good at it. And I'm not here to say that I am perfect and the best trader in the world. I am not. But this is one of the reasons why. It's because you haven't set yourself up success mathematically, and you don't have the right structure to place all of this in the right order. So it's one of the reasons why we talk a lot about this inside the Investors Toolkit, to give yourself a structure that makes a lot of sense, so that you can, you know, if you only got to be right 33% of the time, all you got to do is say, well, what stocks do I choose now? Which is why we give you a list to do that. So that's how you can structure yourself in the right way and avoid the mistake of just saying, oh, it's just a percentage amount. Because a percentage, by nature of how percentages work, you are not going to place yourself in the best places to win based on how that's set up. All right, so that's it for me today. Remember that the code subscribers will still save you $300 on the Investors Toolkit until this Thursday. If you have any other questions, thoughts, or comments, feel free to let me know in the comments below. All right, that's it for me. Talk to you guys later. Bye.